The S&P 500 and Nasdaq 100 now in full-on distribution mode here in mid-April. Q1 was marked by remarkable strength, really by the dominance of those mega cap growth names. Breadth conditions have gotten a lot weaker here March into April. We've documented that quite a bit here on our YouTube channel. But one of the things that was holding the market up were some of those mega cap growth names remaining strong. And it were some lesser known names like Super Microcomputer and MicroStrategy continuing to make higher highs, and in fact, new all-time highs, but also the Magnificent Seven names as well. That's now starting to change. And as we wrap this week, all of those names, Super Microcomputer, MicroStrategy, Amazon, Netflix, all breaking below their 50-day moving averages. What does that mean for the broader markets and risk-off conditions through April into May and beyond? Before we get to the video and all of those charts, here's one more thing I wanted to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So here we're looking at the S&P 500 index, and you can see obviously we've gone sort of in a big time risk off trajectory here. Market topped out around 5250 on the S&P, and over the last 2.5 weeks or so, we're now looking to close below 5,000 for the first time since February. This, of course, gets us below the 50-day moving average and also my line in the sand. And I'm a big fan of what you call the line in the sand technique. When you have a market that has been going up, what you want to do is identify the line in the sand on the way higher, right? What's that level looking back that as long as we hold that level on a pullback, the market conditions are overall still constructed. And if we break that level, that tells you there's a change of character, something dramatically different that's starting to happen. I would argue 50-50 is that level. It's called a pivot point, which is that high in February. It also became a low in late February and early March. That level did not hold. So we've broken the 50-day moving average, and we've broken that line in the sand of 50-50 just in the last week. I would argue that opens the door to a much more significant drawdown. Now, today I want to talk a little bit more about the structure of the market and what is causing this breakdown, what is causing the benchmarks to not hold support, what is causing the momentum to clearly go in more bearish ranges. It all has to do with the weightings of the biggest names in those indexes, right? So if you think about the S&P 500 and certainly the Nasdaq 100, they're very top heavy, meaning those largest names have an oversized weight. For example, in the S&P 500, the top 10 stocks by market cap, those Amazon, Apple, Alphabet types of names, the top 10 stocks are about the same weight as about 400 or so of the smallest names in the S&P. That's how big the biggest names have an impact on the market. So if those largest names are doing well, even if everything else is struggling, the benchmarks are going to hold up okay. And we've seen that in recent market history, where the indexes go higher, even though it feels like a lot of individual names are struggling. Now we're starting to see, we had been seeing a bit of the opposite, where the market was going up on strong breath, meaning kind of everything was going up. Now we're actually seeing the indications rotate lower because the leading names are struggling. Here we're looking at two of the first mega cap growth names to break down.
Tesla, of course, has been covered quite a bit in terms of its deterioration. It's more and more become less of a magnificent stock. So I don't think the magnificent level label has applied to Tesla for quite some time. But you can see that it first broke down below its 50-day moving average back in August. So while the S&P was declining, this broke down through its 50-day as well. It did try to recover above the 50-day a couple of times, but for most of 2024, it's actually been below. It actually broke down in early January and has remained below a downward sloping 50-day moving average since that point. So overall, Tesla has been a negative outlier compared to the rest of those mega cap growth names. Now, Apple tried to improve a lot better. You can see Tesla really never mounted an attempt to regain those July highs. But if you look at Apple on the top panel, you can see the July high around 195, 197 was retested beautifully in what ended up being probably a pretty classic double top pattern in December of last year. Tried to get back up there in January, but never really got above 195. And from there, it's been more of a decline. Now, these lagging names in the Magnificent Seven are now breaking down through support. So over the last week, Tesla has broken to a new low, gapping below the 160 level. Apple has now broken below 165. We'll see at this point as we wrap the current week if we close below that level. But I would say the October low, which has been violated for quite some time for Tesla, now very much being tested for Apple. Now, here's the thing. Even though those names have been breaking down, what has been holding this market up, even though other names have been struggling, is that the mega cap names have been doing so remarkably well. So when Alphabet and Amazon and other names are doing well, they represent enough market cap up there that they're able to hold the benchmarks up. That is all starting to change here. And what we've seen in the last week is a group of leading growth names have broken down through their 50-day moving average. Here's SMCI and MSTR. This is super microcomputer, MicroStrategy. Names you may not have been familiar with until they went absolutely vertical in Q1, right? These stocks, had multi level gains here in January into February. The stock chart scooter rankings, which is a proprietary momentum model looking at really a trend following set of tools on multiple timeframes, aggregating them into a composite score, which sort of ranks stocks on a percentile ranking from strongest to weakest. These two names were the top ranked large cap scooter stocks, super microcomputer SMCI, MicroStrategy, MSTR, both in the technology sector. You can see that this week, both of them have had a confirmed breakdown through the 50-day moving average. Now, what's interesting about these is both of them have been making new all-time highs through February and into March. Both of them made a new all-time high in mid-March. And MSTR actually made a new all-time high in late March when a lot of other conditions were starting to rotate lower. Both of them have now broken to a new swing low. Both of them have now broken below their 50-day moving average. Now, those are lesser known names probably. They've become popular because they had such a rally, but those really have pulled back, and they're noteworthy because they had such incredible runs. But stocks like that are very overextended, you'd expect a bit of a drawdown. Here's where the drawdowns are starting to get a lot more painful, and it's the mega cap names like Netflix and Amazon. Now, when I think of the mega cap leadership names, it's Netflix, Amazon, Meta, Microsoft. People have suggested alternative names like the Four Horsemen, the Fab Four, the Final Four. I don't know if I'm in love with any of those terms just yet, so keep the ideas coming if you have any ideas what to call those sort of remaining strengthening names. But overall, what we're starting to see is those technology and communications names that have had incredible runs and have remained quite strong in the face of other growth stocks selling off. Now we're starting to see those show weakness as well. So most stocks in the Nasdaq 100 are already well below their 50-day moving average, but two stocks in particular, Netflix and Amazon, had avoided doing so until Friday of this week. You can see Netflix gapping lower on earnings. That was related to, honestly, their numbers were pretty decent. The biggest, upswing, I guess positive takeaway was the fact that they reported, good subscriber numbers, but They also shared the fact that they will no longer be sharing subscriber numbers going forward. And most investors are taking that as a negative sign. And basically that Netflix is expecting that those subscriber numbers will start to taper off. And so sort of promoting those and leading with those is no longer going to really benefit Netflix. So they, not surprisingly, are going to start to not report those numbers, I think, starting very, very soon. So as a result, investors are sort of thinking of a negative subscriber number going forward, or at least a less impressive subscriber growth than what Netflix has seen. And as a result, the stock's getting dinged today about 9%. That hurts. That's a big stock having a big sell-off after a big earnings report. Amazon as well. And up until this week, Amazon has appeared largely immune to the market pullback, even though the Nasdaq 100, the S&P 500 have obviously sold off so far in April. Amazon actually made a new high just about a week ago. It was actually pushing $190 a share, getting near that magical $200 level, which seemed like an insane upside objective. But this last week, Amazon now closing below, potentially below its 50-day moving average for the first time since September of last year. So if you look to the left on the charts of Netflix and Amazon, the last time you had been up and ascending above an ascending 50-day moving average for quite some time, and then finally broke down through that ascending 50-day moving average. That was right after the July market peak. That happened for both of these stocks in August and September. And after those initial breaks, you ended up having another month or two of declines leading into a major low in October. And while the month timing doesn't line up with what we saw there, the dynamics of these turns are very much matching up what we saw back in that period, summer of last year, where these stocks that had been above upward sloping 50-day moving averages are now failing to hold those. One of the things that was sort of preventing us from being too bearish on this market was leading names like Netflix and Amazon holding up. For now, it appears that they are indeed breaking down.
So we've gone through this deterioration here recently in some of those leading growth names that have really marked the strength of this market. When the strongest names are not looking so strong anymore, that usually tells us we're in a confirmed transition phase. What do you think about their impact on the S&P 500 and the Nasdaq 100? What do you see as coming up in next for those major benchmarks? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a good one. We'll see you again soon.